Welcome to the Candlestick Forum training for the morning and evening star signals. Hello, my name is Steve Bigelow. I've got over 35 years of investment experience with 25 years oriented toward candlestick analysis. I've written 3 books on candlestick trading, and through the years I've discovered that out of the 50 or 60 signals, there's only 12 major signals that you need to learn. 6 bullish, 6 bearish. Today we're going to go through one of the major signals. We'll start off with the morning star signal, which is a bullish signal at a bottom of a trend, and end up with the evening star signal that is a signal at the top of the trend showing a reversal. The morning star signal consists of 3 trading days. You have a downtrend, then you have a big dark candle, then you have a day of indecision. That day of indecision can be a multiple number of signals, just as long as it's an indecisive day. The third day has one criteria. It needs to close above the halfway point of this candle. Remember, the halfway point in a candle body is very critical to the Japanese race traders. It basically tells you the bulls have now taken over the control of what the bears had in control previous. The morning star signal is very symmetrical. As we can see, we've got a strong downtrend, and part of the investment psychology put into a graphic depiction. Where do most people sell? They start panic selling in the oversold area. Big candle to the downside. The next day is an indecisive trading day, followed by a third day that closes more than halfway up this candle. Easily seen that there's been a change of investor sentiment. The symmetrical reversal is usually going to occur when your stochastics are down toward the oversold area. But as you can see, we were in a downtrend, dark candle day, a day of indecision, a hammer doji type day. Third day closed more than halfway up this candle. The probability is now that you are now going to be in an uptrend. And the most critical part of the reversal is that the third day closes more than halfway up the last dark candle. That essentially tells you the bulls are now in control, where the bears were in control at this point. This is a critical factor. That's why the number 2 is so important in candlestick analysis. As we've seen in some of the signals, the tails are 2 times greater than the body, or a strong reversal or a confirmed reversal is with a close above the halfway point of a previous candle. The first clue that there could be a reversal coming is where do most people sell? They panic sell at the bottom. A big down day, especially when you're down here in the oversold area. If you see that day of indecision, start watching for bullish trading the next day. If they close this above the halfway point of this candle, that tells you the bulls have taken control. And the best aspect about a morning star signal is just how symmetrical it is. Big down day, day of indecision, third day closes more than halfway up this previous candle. Essentially just tells you that the bulls are now taking control and ready to start the uptrend. And it doesn't matter what the indecisive trading day is. Now, a doji is preferable because, as we have learned in the past, that a doji incorporated into a candlestick reversal signal usually adds a little bit more strength to that reversal signal. However, there's all sorts of indecisive trading days. The inverted hammer, the hammer, spinning top, just a small trading day. Anything that shows indecision between the bulls and the bears, followed by a third day closing more than halfway up this candle, is going to create a symmetrical reversal. As with all the other candlestick signals, the T-line is a very effective trend indicator. The T-line is the 8 exponential moving average. If you see a candlestick reversal signal, such as the Morningstar signal, and it comes up through the T-line, closes above the T-line, the probabilities of being an uptrend are pretty strong. Now I'll review the moving averages like we do in all the training sessions. The red is the 200, the blue is the 50, and the gray is the 20-day, and they're all simple moving averages. And the reason for that is every major money manager around the world uses those moving averages to make decisions about their portfolio. The T-line is something that we've discovered that is very effective for if you see a candlestick buy signal and a close above the T-line, the probabilities are extremely high that you're going to stay in an uptrend until you see a candlestick sell signal and a close back below the T-line. Using other candlestick signals to confirm another candlestick signal is very effective. For example, Morningstar signal, close above the halfway point. What's our next parameter is to get through the T-line. We see a doji right on the T-line. What do we want to see after doji? We want to see a positive candle. They close it above the T-line after the doji, after a Morningstar signal. Tells you the probabilities are that they've hit the bottom and they're going to start an uptrend. A major benefit of candlestick analysis is you can see where the buying comes in graphically. Morningstar signal, Morningstar signal, Morningstar signal. Right here, all in the same kind of support level. Gives us a good inclination that every time that they bring it down, they're going to take it back up. Bring it down, take it back up. At some point, when they break through the downward trend channel, that tells you that uptrend has got a different characteristic to it than the previous uptrends that failed right at the top of the T-line. I'm sorry, at the top of the trend channel. But every time we saw a Morningstar signal, that gave us the probabilities of getting in until we saw a sell signal. And we also see those sell signals failed right here at the downtrending channel. So use the very simple rule of the T-line. If you see a candlestick buy signal and a close above the T-line, the probabilities are extremely strong. You're going to start an uptrend. And it's not too difficult to become prepared for a reversal signal. For example, if we can see the slow rollover, and where do most people sell? They panic sell at the bottom. As we can see, the selling starts expanding, and the further away we are from the T-line, the higher the probability they're going to come back up and test the T-line. So notice we've got a hammer, harami, Morningstar type signal with a doji followed by a positive open. Makes this a doji sandwich, a close above the T-line. All good elements to tell us that we should be in an uptrend from this point. Using candlestick analysis, it's always easy to see when there might be an opportunity or the possibility of a reversal. A big down day in an oversold condition, panic selling. Notice how far away we've moved from the T-line, and then a Morningstar signal closing more than halfway up. Makes it very simple. If they open up positive the next day, you want to be a buyer. Does this look like a great price move eventually after a Morningstar signal? Not right off the bat, but as long as they didn't do any severe selling at this point, we have to take it for granted that this buy signal was eventually going to create an uptrending channel. The Morningstar signal. Now a big belt hold piercing signal. If you look at all this together, it is time to be buying down here. Stochastics starting to come back up and starting a strong uptrend. And what are the stop loss considerations for a Morningstar signal? Very simple. If this is the signal right here, or the candle that told us the bulls were now taking control, if it opens higher the next day and you start buying, you don't want to see it close more than halfway down this candle. If it does, that tells us the bears are back in control. The T-line is probably still acting as resistance. Close out the position immediately. The Morningstar signal has that built-in element of that big down day at the bottom of a downtrend, which usually indicates the last gasp or panic selling, and then you start watching for the buy signal. Makes it very simple. As long as we know they can close it above the halfway point of this candle, any positive open from there tells us the bulls have taken control. Will a price move go straight up once you see a candlestick buy signal? Definitely not. There's all sorts of factors that are in an uptrend, such as the stutter step or the J-hook pattern. Things that tell you that prices don't go straight up, they back and fill. But as long as they relatively stay above the T-line, you continue to hold until you see a sell signal and a close below the T-line, usually in the overbought area with stochastics coming down. But this was a very strong indication that the bulls were taking control. Number one, they closed well above the halfway point of this candle. Number two, they closed above the T-line. Makes it very simple. If they open up positive the next day, the T-line is not acting as resistance anymore. A Morningstar signal and a close above the T-line. Again, we're playing the probabilities. Why do prices go up? Definitely not because of fundamentals. Prices go up because of investor perception. And the Japanese rice traders have graphically revealed or shown us that once you have a close and positive trading, if it stays above the T-line, that positive trading will stay in effect until we see a close back below the T-line. Anytime you try to go against the probabilities, it's probably because you're hoping something different will happen. And that's a very poor investment strategy. A Morningstar signal usually consists of a big down day, a day of indecision, and a bullish candle. But it also can have 2 days of indecision in here. Kind of represents the same thing. Indecision, and then a close above the halfway point. That's still considered a Morningstar signal, just with 2 indecisive trading days. Now, if you have a 3rd day in there and a 4th and a 5th, we change that description from being a Morningstar signal into being a cradle type pattern. But note, once it gets up above the T-line, Morningstar type signal, little Morningstar type signal, you're in an uptrend. And the Morningstar allows for very simple entry strategies. Number one, if you see them open up positive, that tells you they're confirming. But if you also see them open at lower, which is exactly what you don't want to see if you're anticipating the bulls are taking control. However, a lot of times they'll open at lower. I say a lot of times. There's a good percentage of the time they'll open at lower and then start taking it right back up. There's somebody taking profits right on the open. If they come back up through the top of the candle that told us the bulls are taking control, that means it's forming another white candle. And if it breaks through there, that's indicative that the bulls are in control. You can be buying at that point. Little day of indecision, a gap up. That's usually good strength to see the gap up in the 3rd day, starting in the uptrend and closing well above the halfway point. Now, this may seem repetitive, but as we have seen in all our trainings, we try to be repetitive because we're not trying to only educate you mentally what's happening as far as the investor sentiment, but we're also trying to let your mind's eye get a good memory of what a Morningstar or any other signal appears like, and so that we see it often enough, we'll recognize it immediately when we're out there in the trading field. Another Morningstar signal with 2 indecisive trading days. Now, is this necessarily the only thing that's telling us the buying has started? Not necessarily. We've got a piercing signal over here. Came up, touched the T-line, they backed it off, but then had another bullish signal that even if you didn't want to consider this a Morningstar signal, the fact that you have a doji followed by a gap up shows you there's a lot of strength coming into this trade. On top of that, if you can analyze that it is a Morningstar signal, the more compelling your uptrend is going to be. Put everything into the analysis. There's an inverted hammer, confirmed, Morningstar type signal. Inverted hammer, confirmed, Morningstar type signal. At about the same level, just slightly higher than the previous Morningstar signal. So essentially you've got a double bottom, which makes this trend that much more potentially powerful. The length of this candle is one of the parameters that would indicate how strong this up move will be. This really reveals that there's lots of buying power coming in after that little indecisive trading day. And will the T-line act as resistance? As we can see that once they created this little Morningstar type signal in the oversold area, they really didn't stop the uptrend. There was a gap down, but that wasn't even a decisive gap down. The next day they opened up positive and kept us right going, or right on going. But as you can see, this was the clear reversal signal. Japanese candlesticks have high probability results incorporated into them, not because they're high incorporated results. It's because the Japanese rice traders have viewed these type of signals for hundreds of years and came up with the realization, or at least the observation, that these signals work. That's exactly the reason why we're using them today, is because prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals, and those graphics are going to be the same today as they were 400 years ago. They're going to be the same as 400 years from now. Human emotions will not change when it comes to the investment dollar. And a big price move right on a major support level usually is a good indication that this is where somebody is stepping in. And more than likely, it's the institutions. Why? Because if you're an institution and you're ready to buy and you see it's in a pullback, you're going to see what it does once it gets down here to a major support level. With candlestick graphics, we can see immediately what those decisions are. With the same element as the rest of the candlestick signals, the bigger the signal, the higher the probability there's been a change of investor sentiment. This is not the type of signal that's going to take you by surprise. Where do most people sell? They panic sell at the bottom. You see a big down day in the oversold area, start looking for a buy signal. Next day a doji. Makes it very simple. They're going to move it in the direction of how they open it after a doji. That's the simple doji rule. Once they start trading, especially if they come back up through the previous day's high, you've got a good inclination the buyers are there. You can either be buying aggressively, or an aggressive buyer can be buying on the day that signal's setting up, but more conservatively, you can be buying on a positive trading day the next day. Also, the magnitude of that big down day takes you further away from the T-line. Big down day doji, where a positive open, where's a good potential target? Even for a day trader, it should be back up to test the T-line. If it does, obviously we got a Morningstar signal setting up. That would be time to be buying on positive trading the next day. The magnitude of this candle can also almost be estimated by how far away it is from the T-line. You've got a big candle down away from the T-line, a reversal. They usually can take it right back up toward that same trading range. Also making this a very good trade setup for the day trader. And the bigger the third day is, the more compelling that the investor sentiment has changed. As we can see, this would have been a typical Morningstar signal had it closed right here or even halfway up. But this closed way above the previous day's open. So this big candle forming a Morningstar type signal closing above the T-line just reflects that there's lots of investor sentiment coming back in, or bullish investor sentiment coming back into this trend. So we'll go back through and review some of the enhancing factors for making a strong candlestick Morningstar reversal signal. First of all, the typical one, the further away you are from the T-line, the higher the probability you're going to come back and test the T-line. And if that is done so with kind of a candlestick Morningstar signal, big down day took you away from the T-line, indecision day, and then they took it right back up again, almost to the top of the previous candle. The bigger this signal is, the further away from the T-line, the more they gap it up through the T-line, the higher the probability there's been a reversal. And with every candlestick signal, if you see a doji followed by a gap up, that alone is a very strong reversal. If you see a doji followed by a gap up, also forming a Morningstar signal, much more compelling that there's been a change of investor sentiment. This is where you definitely can be buying immediately as long as you see that it's trading above the T-line. A gap up from a doji forming a Morningstar signal. First criteria, gap it up again through the T-line. Second criteria for showing a lot of force coming back into this uptrend, coming off a Morningstar signal being confirmed with a gap up through the T-line. A Morningstar signal a good distance away from the T-line. Remember, a doji as an indecisive trading day for the Morningstar is probably the most powerful of the Morningstar reversal signals. Anytime you see a doji involved with a candlestick reversal signal, it's probably going to act with a little bit more force than if it was some other type of indecisive trading day. The doji represents that indecision between the bulls and the bears. The following day tells you exactly what's happened after that indecision. So we got a Morningstar signal, good distance away from the T-line, well in the oversold area. The next day they gap it up. They gap it up again. This is telling us that somebody is trying to get back into this position very quickly, creating a very high probability uptrend. The big down day clearly tell you they're panic selling at the bottom. Also moving you away from the T-line, spinning top, and then notice the next day they gap it up a little bit, kicker type signal, take it more than halfway up this candle. Very easy to start buying on positive trading the next day. Number one, they're still going to come back up and test the T-line, so you know that if you're buying anywhere down here, that the T-line is going to be your first target, and you can see what's going on at that level. If they do a sell signal, a confirmed sell signal below the T-line again, that tells you the T-line is still acting as resistance. You get right back out of the trade. But the fact that you've had a strong bullish signal in the oversold area, the probabilities are still in your favor that this is going to be an uptrend. A good distance away from the T-line. Notice the inverted hammer Harami. Tells you the selling has stopped. A bullish trading day the next day, closing more than halfway up this candle. This was your indecisive trading day. This was your confirmation the bulls were stepping back in. This was your first viable target to see whether it was time to get right back out. We're repeating these patterns for you to study just so you get the clues of where the high probability reversal situations are going to occur. A good distance away from the T-line. A big down day in an oversold area. An indecisive trading day. Start watching for buying the next day. If you don't buy on the open or positive trading, because there's nothing yet to tell us that they're confirming, you could always put a buy stop one tick above the high. If it comes up through there, now you know logically the bulls are probably coming back into this trade. If you don't buy somewhere down in here, the easiest trade is to watch to see where it opens the next day. If it opens positive, especially at the T line and starts going positive, you want to be a buyer. This Morningstar signal essentially started out with your best friend, a doji followed by a gap up. And remember, as many elements of positive trading you can put into your analysis, the higher the probability you're going to be in an uptrend. A gap up, a close well above the halfway point of this candle. Close right at the T line, gap up again. Now, can there be some backing and filling? Sure, but we've already got the message. The message is they've reversed it and somebody's anxious to get in. There's probably going to be some backing and filling, but this information right now needs to be the basis of this reversal, that they reversed, give it a good strong reversal signal, and they're trying to get back into this position with great fervor. Use all your information that we know about candlestick analysis. Where do people panic sell? At the bottom. If you see a gap down in an oversold condition, start watching for a buy signal. See an indecisive trading day in the oversold condition, if they gap it up the next day and start buying, that tells you there's been a change of investor sentiment. Little Morningstar signal setup, finally confirmed the next day with a close above the T line, again starting a strong uptrend. A Morningstar signal, inverted hammer, bullish confirmation with a booster. Remember, that booster tells us they were still selling. Now there's been a definite change of investor sentiment. They're starting to buy. They've created a buy signal. Very easy to be a buyer. If it opens and trades lower, put your buy stop right here, one tick above where it opened. If it comes back up through there, you've got some confirmation of the inverted hammer and possibly a Morningstar signal. Definitely you want to be a buyer on a positive open the next day, because that's confirming your Morningstar signal as well as telling you the T line's not acting as resistance anymore. The gap up after a Morningstar or any candlestick signal, especially when they close it right on the T line, a positive open gives you information immediately. It tells you your resistance, potential resistance level is not acting as resistance anymore. Very safe trade. The probabilities are if they gap it up after a candlestick buy signal through the T line, they're going higher. What's the worst case scenario? We know to stop out if they close it back below the halfway point of this candle. That told us the bulls were that were starting to take control. A Morningstar signal that starts with a gap up is your best friend. Doji, hammer, gap up, Morningstar signal, positive confirmation with buying above the T line. Now, do all of the trends move this strong, or as strong as a lot of the illustrations? No. There's going to be a lot of times a number of times where they fizzle out and you get back out of the trade. But what this does illustrate is there is numerous times that once you see a strong buy signal, that the uptrend will produce some big profits. Morningstar signal, gap up through the T line, a nice strong day. First potential target, which it went right through. Gap up after a Morningstar signal, you want to be buying immediately. Knowing the results of a candlestick reversal makes it very easy for an entry strategy. Morningstar signal right here at the T line, if it opens positive, especially above the T line, you want to be buying immediately. This takes the doubt out of what to be doing. Anytime we see a Morningstar signal in an oversold condition and they're going to open up positive, you want to buy with a high degree of probability you're in an uptrend, and knowing that your stop is the halfway point of this candle that told us the bulls were in control. A Morningstar signal with a doji in it is usually going to be more compelling. And note the next day, bullish candle with a booster on it. All we really needed to see was positive trading to get it up through the T line, and then we do our basic trend analysis from there. Once it gets started, now we see it comes up to the 50, backs off, takes it into a T-line crunch, starts right back up again from a J-hook. But essentially, if you're buying at the bottom, you want the stochastics to be in the oversold area. The doji, followed by a gap up, makes a good, strong Morningstar signal. Next day doesn't confirm. Does this make this a bad trade? Nope. Just wait for it to close up above the T-line. When it does, you know this was just a little profit-taking day after the downtrend. And the day that the indecision day could be a multitude of signals. As we saw illustrated before, an inverted hammer gives us the clue that the selling has stopped, and then the bulls are in there the next day. Number one, confirming an inverted hammer. Number two, forming a Morningstar signal. Again, all the indicators we can add together to imply there's now a change of investor sentiment, the higher the probabilities that trend will move in that new direction. Big down day followed by an inverted hammer doji, followed by bullish confirmation, Morningstar signal, and supporting right on a major moving average. Again, all the probabilities that we can put in our favor, the higher the probability that trend did reverse. Anytime you see a gap down in an oversold condition, start watching for a reversal signal. In this case, it was a dragonfly doji that bounced right off a major support level. So when you see a gap down, start watching for a reversal. The next day they open up positive, create a Morningstar signal. This is a very strong reversal signal, especially with a doji, dragonfly doji as a reversal signal. An inverted hammer signal confirmed right here at the 200-day moving average, and a close back up above the T-line tells us there's probably been a change of investor sentiment. Big down day followed by, again, that dragonfly doji, followed by a gap up. A doji followed by a gap up is your best friend. Closes more than halfway up this candle and above the T-line. Stochastics coming up. Very simple reason for seeing this result. There was a change of investor sentiment. And the further away they take the signal and redo it, bring it back up, the further away they take it from the T-line and bring it back up and close it above the T-line, the higher the probability the Morningstar signal has created a reversal and the T-line is confirming it. Another high probability factor for a reversal is where is the signal actually occurring. As illustrated in this chart, a Morningstar signal is right smack dab on the 50-day moving average. Close back above the T-line. Tells us you want to be buying immediately on confirmation. A Morningstar signal smack dab on the 50-day moving average and a close back up above the T-line. Observe the obvious. Where do you think everybody is waiting for a pullback to occur to see whether the 50 is going to act as support? Right here at the 50. We have the advantage with candlestick signals to see immediately what investor sentiment is doing. As described in a few of the other training sessions, a few weeks ago, we had somebody ask, how many days does it take to confirm that the trend has reversed? With candlestick analysis, it's 0. All you want to do is see the signal and the signal confirmed. And that confirmation could be a positive trading day and or a positive trading day that brings you back up above the T-line. Is this a good reversal area? Oh, number one, we've got kind of a support area right here. Number two, we've got a dragonfly doji hammer signal. Number 3, we have a gap up through the 50 and a close above the T line, creating a Morningstar signal with a gap up on the 3rd day. All strong indicators that the bulls were stepping in at this level. So support levels do not necessarily have to be the moving averages. All you have to do is see where it bottomed before, and if we see a strong buy signal at that level, it tells us exactly what we want to know. That's where the bulls were stepping back in. Once again, to kind of reiterate the fact that we do not have to wait 3 or 4 days to see if a trend is confirmed. The earlier we can get into a position provides a couple advantages. Obviously, when everybody else is confirming further up, they're adding to our profitability. Number 1. Number 2, the earlier we get in, the earlier we can see whether this reversal has confirmed or failed. Again, that part of cutting your losses short with very small losses and let your profits run. But the compelling information is seeing a reversal occur that we fully recognize, bouncing right up off a major support level. Doji, gap up, confirmation right at the 200, further confirmation with a close above the T-line. As you can see, the results are usually fairly strong from a reversal of off a Morningstar signal. Where do you think everybody was watching to see whether this was going to act as support or not? Right here at the 50-day moving average. Bullish confirmation after the signal tells us exactly what we wanted to know. They decided they were buying right here on the 50-day moving average. Support right on the 200-day moving average. A nice strong day telling us that they aren't going down any further. Further confirmation with a gap up through the T-line and then starting a good strong trend. Most of the time, a Morningstar signal isn't really anticipated, but it can be expected. If we see a doji right here on the 50-day moving average, stochastics slowly coming up, very simple. The rule of the doji, it's going to move in the direction of how they open it after a doji. Had they opened it lower, that would have told us this downtrend was still in progress. Opening it positive tells us immediately that the 50-day moving average was acting as support. We could be buying immediately, just using the 50-day moving average as our stop. But the fact that they gapped it up from where they closed it told us that they were anxious to get back into this position. And the Morningstar signal with a double doji setup down here, right on the 50-day moving average. Notice when they gapped up, they did another change of investor sentiment. They broke out through this downtrending channel. Morningstar signal followed by a gap up through resistance tells you there's probably going to be a lot more upside. The inverted hammer on the 50-day moving average with stochastics in the oversold area would have been our first alert to tell us there's probably going to be support here. Next day, positive open, positive trading, you definitely want to be a buyer. With the anticipation that all it has to do is close more than halfway up this candle and you've got a reversal. The fact that they closed it well above the 200 and the T-line gives that much more probability you're in an uptrend. Morningstar signal right on the 200-day moving average. Be prepared to buy immediately on positive trading. Another support level, not quite a Morningstar signal. Did not close above the halfway point of this candle. Following day did confirm though with a gap up. Another little dynamic of a Morningstar signal is that if you see it at the end of a flat trading range, it acts like a little mini scoop, which will usually have a slingshot effect to the upside. As you can see in this illustration, you had kind of a flat trading area, then all of a sudden a little mini scoop that act like the slingshot effect that came out the other side. Anytime you see flat trading and you see a Morningstar signal, that means there's been a definite change of investor sentiment. Something's happening. add the mini scoop potential based upon support right here at the 200, that much more compelling. They're going to have a slingshot effect coming up the other side. Witnessing a morning star signal and then be able to look back and say, well, I got kind of a flat handle here, also gives that impetus to be buying because of the slingshot effect coming out the other side of a scoop. This is just a fairly high probability trade, kind of a flat, indecisive trading, morning star signal, bam, they'll take it up hard from there. Still the same parameters. If it fails, it's going to fail quickly and you're right back out of the trade. Like many of the other candlestick signals, if they are forming up in a pattern like the scoop pattern, take advantage of that information. A lot of people will see this as a flat trading and still flat trading, but if we can recognize this is a candlestick pattern at the end of flat trading, we're immediately in there well ahead of everybody else before the uptrend starts. You can make a lot of money with this pattern only because everybody else sees it just as waffling. We see it as a recognizable morning star signal that, if confirmed, has a lot of upside potential to it. Especially works well with options because obviously after trading flat like this, even a little bobble still doesn't affect the premiums all that much. You can get into the option trades very inexpensively, waiting for the upside move. All right, we've looked at a lot of charts. Candlesticks signals or morning star signals are very symmetrical. Let's just kind of review real quick what we've learned about candlestick morning star signals. The signal being formed by gap ups is a very strong indicator that there's going to be a lot more upside. And like all other candlestick reversal signals, the further away they move from the T-line, the higher the probability they're going to come back up and test it. So the worst case scenario is you buy on confirmation. Even if it fails up here at the T-line, you might come out with a little bit of a profit if you got in at the right place at the start of that trend. And a morning star signal can have 2 days of indecisive trading instead of just one. Still represents the same thing. It just took 2 days of indecision before the bulls stepped in. Then once they've gapped up through the T-line, you still got a lot of upside potential until you see a confirmed sell signal. So watch for gap downs in an oversold condition. Where do most people sell? They panic sell at the bottom. When you start seeing gap downs in an oversold condition, start watching to see a buy signal. This rapid movement to the downside at the end of a downtrend is usually the panic selling, which drives it away from the T-line. And we know the probabilities of a T-line is that the further away they move away from the T-line, the higher the probability they'll move back up to test it. And a double doji morning star with the gap up on the fourth day, closing more than halfway up this candle. Makes this very simple for entry strategies. If it opens positive or trades positive, it tells us the T-line's not going to act as resistance. So you're coming out of a candlestick reversal signal and breaking through the T-line. When you see a morning star signal right on a major support level with stochastics in the oversold area, it basically tells you that everybody that was waiting for the 50 to see if it's going to act as support is now buying, and we see that immediately. And it's forming a reversal signal, so we don't have to wait 2, 3, 4 days for confirmation. We can be buying as soon as we see the candlestick signal confirming. A morning star signal is just a very simple, symmetrical reversal signal. Down day, day of indecision, up day, with 2 criteria. 1, I guess basically one criteria, that the third day closes more than halfway up the down candle of the first day. The question always arises, should I be buying after it closes above the T-line? Got to remember, the first criteria for any analysis is the signal itself. Further confirmation, a close above the T-line is an extremely high probability confirmation, but it's not the criteria for getting in or out of a trade. Now, we can use it if the trade or the price has stayed relatively close to the T-line. We just like to see if it's breaking out through that downtrending channel. On the other hand, all the T-line is a confirming indicator. The signal is what you want to be trading off of, and then see what it does once it gets to the T-line. And the evening star has all the same elements of a morning star except opposite. You have a big up day, a day of indecision. A third day closes more than halfway down this candle. You usually want to see this occurring when the stochastics are now in the overbought area. Evening star signal because it tells you there's darkness to come or a downtrend. The evening star signal has the same parameters. Where is it occurring? Looks right here about the 200-day moving average, and it closed below the 200 and right there at the T-line. If it opens lower after a reversal signal, you want to be shorting immediately until you see a candlestick buy signal, which in this case is a morning star signal followed by a gap up. And the bigger this candle is, the higher the probability investor sentiment has changed, especially with a close back down below the T-line. The further away the evening star moves from the T-line, the higher the probability it's going to come back and test it. Where the morning star is very effective, if it's seen occurring on a support level, the evening star is very effective for showing us where it occurs at a resistance level. And then if it closes below the T-line, you're in a downtrend until you see a buy signal. The evening star is just as symmetrical at the top as the morning star is at the bottom. And it's much more effective if you see a doji as far as the indecision day. Where do people buy? They buy exuberantly at the top. If you see a gap up in the overbought condition, start watching for the sell signals. Very plain, symmetrical, or plain to see symmetrical reversal tells you there's been a change of investor sentiment. And the critical or crucial element is that this candle closes more than halfway down the last big bullish candle. Even though they took it back up, they couldn't get it above this level. Tells us that the sellers were now taking control. The evening star signal with a hanging man and a close back below the T-line starts the downtrend. And adding all the elements that you can to make this a feasible reversal, such as the further away you move from the T-line, the higher the probability it's going to come back and test it. The bigger this indecision day is, the higher the probability they've reached a peak and starting to go the other way. Again, the third day should close below the halfway point of this candle. Obviously starts the downtrend. And just like the morning star signal, the evening star signal doesn't have to be obviously symmetrical. You got a big up day, doji day, gap down, bearish candle closing well below the halfway point of this candle, starting your downtrend. Sometimes it's fairly obscure, other times it's very symmetrical. The T-line is a very important indicator. We want to see a candlestick sell signal and a close below the T-line. Not quite there, but that was a reversal signal. Notice at the same level, we got the same signal, an inverted hammer signal, evening star signal, this time with a close below the T-line, starting your downtrend. The T-line and candlestick signals are very important combinations. And an evening star signal with kind of that inverted scoop pattern will provide a slingshot effect to the downside until you see a candlestick buy signal and the close above the T-line. That concludes our training on the morning and evening star signals. The main element is that it's a very symmetrical signal, and it's got a lot of other aspects that can be built into it, such as a gap up from a doji or gap down from a doji, a close below or above the T-line, depending on which signal. It is a very easy signal to recognize, and that's why it's one of the 12 major signals. The probabilities of seeing a reversal upon one of these signals is extremely strong. That'll be it. Hope to see you in the chat rooms. Thank you for listening.